Hey guys, it's Dragen here. Today we're going to be going through how to invest in startups just like the Dragons from Dragon's Den to ultimately make money and increase your net worth. We're going to be covering how you should find companies to invest in the first place, how you should analyze those companies, what strategies you should use for this type of investment, and I'll be giving you a lot of tips along the way. But first, let's go down to the principles. What is a good startup to invest in versus what it isn't? This will help you avoid putting money into companies that you might lose money in. Also, none of this is financial advice. Please seek a suitably qualified professional for that. A good startup in the investment sense is a new business which has a potential for scale. Like for example, you can invest in somebody's plumbing business. Now, that business might be highly profitable for that individual, but it doesn't mean it can scale well. And I'll explain what this means. That one person cannot service 100 houses additionally than he is doing now without actually hiring more people. Generally, when a business's growth or expansion relies, tremendously on hiring people, it's less likely that it can scale well. What is scalable is technology, for example, an app that can, once it's built, it can reach 1 billion users. Something like Instagram or Snapchat, where each additional user signing up to the platform doesn't actually increase the cost of running the platform quite tremendously. It's not only technology, guys. Products also have good scale. A company that sells a range of Caribbean-inspired sauces can also scale quite well. The reason is that as more and more people buy its products, the company can go back to its suppliers and buy those ingredients to make those products at cheaper rates because it can bulk buy more. Therefore, it can save on costs and actually scale quite well. In other words, it has economies of scale. Now in Dragon's Den, these guys have the privilege of deals coming directly to them, but the option available to individual investors are on crowdfunding sites. These websites allow individuals to look at various pitch ideas and read them in a digestible format and also invest from as little as £20. One of the sites you can use to find these pitches and these ideas is seedrs. The other is crowdcube. Now they're pretty similar in nature, so we're just going to use seedrs for the purpose of this video. Now before we actually start judging these companies and going through them, let's actually try to understand the strategy behind venture capital. By looking at established venture capitalists who do this day in and day out, we can actually reflect upon their strategy into our retail model. Why I found that venture capitalists do is that they spread their investments in a large volume of startups every single year. This is largely because a lot of those companies will fail. A lot of those companies would actually end up failing or not doing as well as they hoped. But the idea is that, let's say for example, 2 out of 30 companies you invest in end up hitting it out of the park and becoming the next giant in their space. You're basically going to be making up for those failures and then some. Let's say you're investing in 30 companies at the start of the year. 20 of them go bust as time progresses, the business model didn't work, and let's say 8 of them are doing okay. They're not doing that great, but they're just doing alright, they're just surviving. But 2 of them are the Revoluts of the world. They're dominating the industry. They're billion-dollar companies that went from a £42 million valuation to a £1.2 billion valuation just after 2 years. If you had invested in Revolut's pitch during that time, you would have gained a 1,900% return on that investment. With that sort of gain, you would have made up for those losses and had more money to invest. Now, it's definitely not guaranteed that it's going to be 1 out of 30. It might be more, it might be less. It depends on various factors we're going to be going through in a bit. Jason Calacanis invested in 21 companies before 3 of them became billion-dollar companies. And out of 3 of them, 1 of them was Uber. Now, before we actually go ahead and actually start judging those investments, there's important tips you need to know which would increase the probability of getting those outliers and those winning investments. Now, these are just my opinion, but the number one thing I think you should do is stick to a particular industry, and also stick to an industry you specialize in or what your background is in. If your background, your studies, and where you've worked is in technology, stick to technology businesses, because you'll probably understand them better, and therefore you'll be able to understand where the business model is and whether it can go forward from here. If you had run a clothing line before, you would exactly know the challenges you faced and whether this particular investment in front of you is going to be successful or not. You would have a better idea of understanding the business model and all that comes with it. It's like with all types of investments, we don't invest in things we don't understand. The second thing is, as I mentioned, make sure you diversify your investment. It's unlikely that one company you invest in, just that one company is going to be the next billion-dollar company. You might get lucky and just invest in one, but it's unlikely. So you want to just keep your diversification quite good to actually mitigate against risk. The third thing I would say is have conviction in the companies you invest in. Don't just go out there and invest in 30 companies or whatever. Have some conviction. Does this company actually have a chance at survival? And the only way to do this is, my next point is, do your proper due diligence. Really look at the numbers, look at the data. Does it make sense? Is there credibility behind them and their company? Which brings me to point number 5. Are there industry experts who are invested in that particular company? That gives a little boost to the credibility of that organization. For example, I'm more likely to invest in a EV company, electric vehicle company, if Elon Musk is actually putting that money in, because he has the experience of running Tesla. So he probably believes that this company has some sort of potential. At number 6, look at the founder's background. Do they have experience in running this type of business themselves? And also, what makes them the right person for the role? Sometimes you'll see on Dragon's Den that the business idea could be great, but the founder doesn't have good credibility, or the Dragon doesn't believe in the founder's honesty, doesn't invest. The same way you got to do it here as well. You can't invest in every company just because the model is good. You've got to look at the person as well, the person running it. You'll be able to find this information quite easily online, on LinkedIn, on Companies House, whether they are actually proving what they are saying. And number 7, my last point is that you should actually think, is this the right amount of money they are raising? Let's say a founder has launched an electric vehicle company but only wants to raise around £50,000. We all know that the car company isn't going to be profitable with just £50,000 investment, so they're likely going to need more money, which can either mean two risks to you. Either the company falls because it can't raise more money, individuals just lose hope in the company being profitable in any case, or they are able to raise more money but your shares get diluted. If the company issues more shares to new investors, then your shares ultimately become less valuable. So with these things in mind, let's actually get straight in and judge a few pitches to give you a better understanding of how this whole thing works. Oh, and also, if you're learning something new, please make sure to subscribe and hit the like button to support the channel. Anyway, let's get back into it. Now, in a normal case, I'll probably be looking at technology businesses because that's my background. But in this case, I want to give everybody sort of a chance to kind of understand how you can analyze other types of businesses. So I'm going to be more or less looking at other industries as well. So the first business we can look at is Nicks and Kicks. Now this looks like a kind of a drinks brand, right? The drink with the zinc, right? Okay, we'll be the judge of that. So a refreshing, sparkling soft drink that is full of flavor. Okay, 5 million products sold. That's a massive amount. That's quite a considerable amount. 7.5k distribution points. Yeah, okay. High repurchase rate versus the category in a key retailer. They probably identified a retailer whereby they're sort of winning against their nearest competitor. That's how I read it anyway. 90% 5-star reviews. I mean that doesn't really give me anything, right? Because it depends. Because Amazon reviews, we all know they can be not there in terms of the integrity. It's something, but I don't put too much into that at this point. It's quite good what they've got here. They've launched in Tesco's, right, in 1 year, and it seems like Tesco's found that this brand is quite good, so they've actually increased the number of stores their product is selling at to 450. Now we don't know what originally the amount was in the first place, but 450 stores, that's quite good. I'm actually not seeing this brand though. That's strange, because I do look at these things and I haven't actually seen this. Maybe me though. They've got this partnership with Nando's. I mean, that seems quite that's quite big, because they're a restaurant, and for a restaurant to take a product on, because they've always got a limited selection anyway in comparison to retailers, it's quite a big achievement in my opinion, at least. See, the investor perks don't really do anything for me. I'm not really in it for little t-shirts and all this kind of stuff, right? If we're trying to make some good money out here. So, but other people might be, you might be. It's still a good bonus, right? You get a t-shirt or whatever, like. But I'm not really in it for that. The company had an outstanding bounce back loan, £50,000, interest free. Why did you guys take a bounce back loan? None of the funds will be used for this loan, so that's quite good. So they're not raising money to pay off their loans, for pay off this loan. So do they have other loans? Worth investigating. This is a convertible investment. It's a different type of pitch. They don't give you shares straight away. It's more of like a way to give you discount for these shares in the future compared to other investors. It could be quite profitable, but it's just another kind of, it's just another headache, to be honest. In my opinion, some person has invested £132,000. So yeah, you get the idea. This business is quite decent. I'm not too much of a fan of the convertible kind of deal structure they've got here. Just for that reason, I'm probably out. But I just want it to be clean equity. That's all I want. Now, let's say you make a few investments and one of them is doing quite well. What are your exit opportunities? How are you going to actually sell off those shares and make money? Well, there's 3 ways to actually do this. One of the ways is acquisition. Mumford Chef was a company listed on Crowdcube, which was eventually acquired by Nestle. Acquisition is when a bigger business swoops in and buys you out as a shareholder. The second way is through the secondary market. Now, some pitches also allow investors to let go of their shares, sell their shares on the secondary market on these platforms. It's kind of like a stock exchange, but only available on their platforms. And the third way is that the company you invest in becomes so successful that it listed on the stock exchange. You'll be able to then buy and sell shares of that company just like any other share like Apple. Jason Calacanis has also done this with Uber. As soon as it hit the stock exchange, then he sold some of his shares. Unlike you would get with investing in established companies like Apple and Google, startup investing allows individuals to also take advantage of high amount of tax reliefs actually available to the average investor. Now, that's a whole nother video to discuss what actually is out there. But if you're eager, then feel free to check out the guide available on seedrs. Now, these companies don't actually pay a dividend payment for the most part, but if you do want to build a passive income stream, then make sure you check out my video here and I'll take you through that whole process. Anyways, thank you so much for watching and I'll see you in the next video.